thank you all for attending today's session. Today we have a workshop with Michael Lind, who's from Golden Gate Ventures. Michael has had a few quite successful startups in the past, and now is a venture partner at Golden Gate. They specialize in Series A and B VC investments, and I won't take much of your time, and I'll let Michael do an introduction about his own career and his company, and I'll leave it up to Michael.
Awesome. Thank you. So first of all, thanks to the QFC team for having me. It's good to be here. I'm spending the entire month in Doha, so I'm right across the street, right there in the Dusit Hotel. So that's my home. This for the next 4 weeks. I'm not going to talk about myself, by the way. We are going to talk about startups and running your company and investments and how awful investors are. So, but I'm going to briefly talk about myself so you guys know who I am and why I'm standing here. My idea for today is that you guys take away what the importance is from an investor standpoint when you look at tech companies and what you as a founder need to think of. And there are a lot of pitfalls when it comes to fundraising, growing your business, working with co-founders, so we'll touch upon all of it. I can talk for hours. You can ask my kids. If you just let me talk, I'm going to talk for like 4 or 5 hours, but you're all going to fall asleep. So what I want you guys to do is if you have questions, just raise your hand, tell me please your name, what you do, and then we can have an interactive discussion. Is that okay? Yep. Yep? Okay, awesome. Okay, very, very briefly about myself. So first of all, I'm a dad. I have 2 kids, Lana and Amare. So Lana is 11, Amare is 7. My kids are crazy, but I do love them. I'm a husband to Marijke. She's back in Singapore. That's where the family lives. I'm Dutch, by the way, as you can hear about my accent. I'm a partner at Golden Gate Ventures. We're an early stage VC fund based out of Singapore. I'll tell a little bit more about our fund and our history. I used to have a short political career, which is about 4 years. I was a vice chairman for the Economic Development Board, helping public and private relationships across Rotterdam in the Netherlands. And I used to be a co-founder. So I used to run a business, which is data centers, back in the Netherlands. This company got acquired in 2007. Just so you can guess my age, maybe. And it was actually funny because when I started my business, like VCs was not really a thing. We started right before the big .com bubble. Who remembers 2000? A few, right? Yeah, and the young kids are like, what are you talking about? So it's like now, but then worse than a long time ago. So when we started our business, we didn't go about raising money from a VC fund. We actually self-funded the company and never raised a dime. When the company got acquired, we noticed that owning 100% of the business is actually really funny. Because when you do an exit, it becomes very, very significant for the founders. But we're going to talk a little bit about sort of my founder journey, and then also how do you work with VCs and how do you allocate capital and shares and how to go about it the best way, because in the end you want the best founder or the best exit for yourself at some point in time as a founder. I have some extracurricular activities. I'm a co-producer of a documentary. I really care about social impact globally. So we made a documentary. It won a few awards in the US. And I love running marathons. And as some of you guys know, riding bikes, because I brought my bike to Doha. Which wasn't very smart, by the way, but it's okay. So quickly about the company, and I'll again keep it short. So the business started in 2011. The way the company started is, so Vinny and Jeff, 2 co-founders, they met each other in Singapore back in 2010. And back in the days, there wasn't much venture capital in Singapore. You had like a few funds, not too many, a lot of angel investors. And we actually kind of helped build the ecosystem. So over the years, we've invested in currently over 90 companies, anywhere ranging from seed, Series A, and some Series B companies. We've had about 9 exits, about 7 unicorns in the portfolio. We currently manage about $250 million, and we have 20 people across 3 offices in Singapore, in Indonesia, and Vietnam, and who knows what comes next. Some of our investments.
Even after Qatar.
We're still talking, so who knows? So some of our investments, some names you might recognize, some you probably won't, but Stripe is a well-known company. They're a payments company out of the US. So we invested when they expanded their business into Asia. GoTo, they used to be called Gojek. It's a ride-hailing company, so similar to Kareem out of Dubai. So they were listed about a year ago. And for most of these businesses, and we'll talk about later about defensible strategies, most of these are copycats, but they're very specific to the Asian region, and that's what makes these businesses unique. Cool. So I want to kind of keep it towards this, and I have like a lot of content. I have a lot of things to talk about. So please, if there's any question, if it goes too fast, too slow, if you want to know anything, want to dive deeper, please let me know, okay? So just stop me and let me know. I want to talk about whether investing is an art or a science. And the reason why this is important is oftentimes when if you go to Silicon Valley and if you talk to all of the large firms like NEA, Sequoia, First Round, they all kind of talk about their successes in a way that they found these companies almost serendipitously, where they bumped into an amazing founder in a cafe and they ended up having a conversation and then they invested and it became a unicorn and everyone became very rich. That sometimes is part of it. But there's actually a science to it as well. So I want to talk about both parts of the investment landscape. There's an article in The Economist. It's an older one, but it's interesting. It talks about how do you get from point A to point B. So what do you do as a founder? You wake up, you're in the shower or you're having breakfast, and you think of an idea. That's your point A. And then you're going to be fundraising. That might be your point B. And you're going to have co-founders. That might be your point C. So you're continuously going from one step to the other. But it's impossible for this to be all art. There has to be science to it as well. So for me, what is the art is getting to know the founders. If you invest, at least as an investor in an early stage company, getting to know the founders is extremely important. I'll tell you like a funny anecdote. This actually happened in our office. So this was the last conversation after 5 or 6 interviews across all of us partners. And we noticed something weird between the founders, some weird dynamic. And at some point, one founder talks about their growth strategy into a new country. And I saw that the other founder became very uneasy. So he did this like, hey. And so all of us were like, oh, there's something wrong in this dynamic. So even something as small as this like little argument in this conversation could lead to us walking away from the investment. We ended up not investing in this company. And the founders got into a fight about a year and a half later. So having this sort of founder knowledge is very, very important. The other thing is about market dynamics. So I told you guys earlier that for most companies in our region, in Asia, they're copycats from other regions. Like no one is reinventing the wheel. If you see a company here, 9 times out of 10, there's a similar company somewhere else in another market, which is fine. But it's very important to understand their market dynamics. If you go, this is the most funny example. So alternative proteins and alternative meats, very big companies, Impossible Foods, and there's a few others. It took them a very long time to understand the Asian market. Who knows why?
Culture.
So cultures is one thing, but Impossible is a premium product, right? So if you go to Indonesia, I mean, I can eat on the street for like $1 and have good food, like actually really good food. So for a consumer to consider alternative food at a very high price point versus around the corner at a very low price point, but the food is of very good quality, you have to have an extremely good product here for me to pay a higher price? So understanding those market dynamics is extremely important. The other thing which I call art as well is the network effect. And we'll talk about it more later, but I cannot emphasize enough how important it is for you as a founder to have a network. If you go into a new market, for an example, when you know the local government, when you know the big companies, when you know the big CEOs, when you know who is your local competitor, when you know who to partner with, it's going to give you a head start. So it's very, very important to think of, does this founding team have a network effect, yes or no? It could be from a previous company, it could be from a community, it could be from family, it could be from anything. Consumer and customer dynamics, I talked a little bit about sort of the food in Asia, so it's very linked to market dynamics, and then understanding trends. I'm crazy about sports. I love, love, love sports. So I just got a pitch, this was 2 weeks ago. It's a smartwatch for athletes. I have every single smartwatch on the planet. Like, I swear, like every single smartwatch that has ever been invented, it's in my home. So this guy says, Mike, we're doing a new smartwatch, which is actually a very nicely designed watch, but it still has smartwatch elements to it. So if you go for like a walk, then it counts your steps. And if you go for an exercise, it tracks your exercise. The only issue is that if you have a designer watch, it has to be either really well designed, that you kind of attract a designer audience, or it has to be a really good sports watch. If it's in between, no one is going to buy it. So really kind of understanding those trends and why that happens is very, very important. Okay, so I'm going to skip this because we're going to talk about it later. Does everyone understand this part? Good, okay. So whenever we look at deals, for us it's very important to do both sides, to do both the art and the science. We have a very good team of folks that love the science part. I'm more focused on the art part when it comes to looking at deals and investments. Okay, I got a trick question. You can't win a prize, but I'm just going to see kind of who knows. How many deals do you think I see in 1 year, approximately?
What's the funnel? You mean the funnel?
Yeah. So how many deals do I see in like all deals?
Applications.
Yeah.
Deal flows.
In 1 year, deal flow.
What size?
Couple of thousand.
Doesn't matter. Just any deals. That you think a couple of thousand, like 2, 3, 5, 6.
That's a trick question.
3,000. High? Do I get a number higher or lower?
I would think two.
2?
Shortlisted or bulk?
Doesn't matter. Just on my desk. New deals on my desk.
So you don't have a filter before it's on your desk?
No filter yet. Correct. Yeah.
So it's probably 1,000 a week minimum.
1,000 a week. I'm basically not that busy, by the way. Who else? Other numbers?
For answering, what's your ticket size?
Hmm?
Like, are you early stage?
Doesn't matter. I'll tell you why. So give me a number.
Okay, 5,000.
5,000. Man, I'm not that busy. I'm busy, but not that busy. So it's about 1,000 a year. On average, if you look at most firms, they would get about 1,000 a year. If it's early stage, the number kind of fits most VC funds. Some have 1,200, some have 1,100, but like 1,000 a year. How many think do we invest in the end?
1%.
That's easier. Yeah, that's a very common number, 1%. So what we tend to do is, this is kind of our evolution process when you look at deals. And I always explain this to founders because the moment you're here, I guarantee you that we've heard your story before. I've heard your story before. And if someone tells me that we haven't, I can pull up a pitch deck and find it for you, and I've heard it before. Doesn't mean, it doesn't say anything about your company. Your company can still be good or can still be bad, but I've heard the story before. And then we go all the way down to making a decision, which ends to be at 1%. This part is often underestimated. When you get past the initial screening, this is a big component for VCs. And what does socialization, what does it mean? What do you think it is? So together with the founder, but what do we do?
We need to get to know more.
So you get to know more? And how do you think we do that?
Maybe through their, follow their LinkedIn profile.
Yeah, so that's good. Yeah, so you do a bit of data analysis on the team, a bit of reference checks, and that's, other things.
Chemistry.
So chemistry. So let's say it's a solo founder. Is it chemistry between us and them, or between the founders? What do you think?
I think it goes all the way, like it maybe, both ways.
Yeah.
The founders themselves,
Mhm.
there's chemistry between the founders and the board.
Yeah.
There'll be board meetings, there'll be a relationship follow-up. So is it smoother, is it choppy, is it friction?
You know, the one thing that I do at this point. So the screening part is very scientific, right? Does it fit our thesis? Is the check size, does it fit our mandate? All that kind of stuff. So this is very scientific. And there's part of art here as well. The biggest art is here. And you know why? Every single early stage company, every single one of them pivots. And it doesn't matter if it's a big pivot or a small pivot, every single company at the early stage pivots because you don't know what's going to happen in the next few months or in the next few years. So what is important for me here is to get to know you if you're not going to mess up when you pivot. And it sounds very harsh, but it's true. So what happens here is I will check how you behave outside of your work environment.
How you behave?
Outside of your work environment.
Okay.
Why is that important?
Rational, emotional decision making.
Yes. One of the hardest things on this planet is building a company. I compare it to like chewing glass. That's kind of the same feeling. It's very painful. And it's painful all along the way. If you're getting ready for an IPO, if one company that's getting listed, well, hopefully, getting listed next year, it's a painful process. If you're starting your company, it's painful. Fundraising, it's painful. Getting new team members, painful. Going into a new country, painful. You get the idea, right? So what I need to understand here is that through all of this pain,
Is he prepared?
yeah.
Is he ready?
So no one is prepared. No one is, like, you're never going to know what's going to happen. So no one is prepared. But are you mentally capable of going through all of this tough stuff? So I spent a massive amount of time here because, again, this is technical. This is fairly technical, and this is all technical. But this is extremely important.
So it's a matter of attitude.
Yeah, yeah. And I also want to understand, to give an example, I want to understand if you are a two-person company at this moment and we're having a conversation, how are you going to behave if you have like 100 employees? What kind of leader are you? So this is crucial for me. Getting through this phase is oftentimes underestimated by founders, unfortunately, because we all think it's about this, this, and this, and then we skip this. But this is crucial in any part of pitching to a VC. And you'll notice that older partners, so I'm 47, so I'm older, they have a way of almost asking the right questions without you knowing it. And you think, okay, I'll just give an answer, and then you see me taking notes, and then a week after I say, I don't think it's a fit for us. And I always try to explain why that is. This is oftentimes a very big part of it. So I'm spending a bit more time here because in your pitch, and as you are pitching to investors, just think of, okay, what kind of person am I? And do I connect with this investor that I have on the other side of the table? So this is very important. Cool. We're going to talk about eating glass. So the founder's journey.
Can I ask you a question?
Yeah, of course, please.
Right?
Yeah.
So you have decision after the due diligence.
Mm-hmm.
Don't you decide before investing and then due diligence and then you do the closing afterwards?
It's a very
You do the diligence and then you decide.
It's a very good question. So the question is like, don't we actually decide kind of here already, or maybe even sometimes here already? Not always. We have had instances where, for me, there's two types of due diligence. One is it's confirmatory. We want to make sure that everything that we checked here is still in check. And then there's a legal DD that we need to do to make sure that there's no, criminal activity and so on. Typically, when we get to the legal DD, we've already decided. And we kind of know this is going to work out and we'll make it happen. But we still do a lot of work before that moment happens, just to make sure that our decision is sound. So one thing that we do is, as part of our due diligence, all the partners sit separately with the founder. And we do this if you sit together. Let's say you and I are having a conversation with a founder, and then what happens is I ask a question, and then you're asking a follow-on question, and we kind of riff off each other. If I have a separate conversation with the founder and you have a separate conversation, you have two different angles, and you get more data points. So we tend to have all of the partners talk individually to the founder to get more data points, and that's part of our due diligence. Yeah.
Thank you. I was just going to ask on the socialization, how are you assessing that? Thanks. What kind of things are you looking for? How are you assessing it when you say, outside of the working environment?
Yeah, so we had one company in Indonesia where so we had a larger founder dinner, and we told this founder, hey, we kind of like the business, why don't you come join us? And we have our founders here, just have a conversation. And I just then step back and then see how this person interacts with other founders. So that's kind of one way for us to do it. I ask a lot of personal questions about your history, choices that you made, why did you make them. I always ask about biggest failures. Like, what was your biggest failure in life, and sort of how did you get through this period? And then I want to get a sense of yeah, some founders say, oh yeah, failures now not really. I've always been amazing, and okay, that's interesting. So I try to sort of get to the person behind the founder. So just by asking questions and doing interviews. Sometimes I'm really annoying. Sometimes I ask my wife to meet them. And then just in a casual setting, and then she'll just pop by and just give you coffee, and then you have a conversation, and then she's like, I kind of know about this one. So it's and again, it's just helpful to get sort of different inputs. Yeah. Sorry.
From your experience, Mike, what is the different proportion of each stage? Like, we know that the last one is 1%, starting from 1,000 with the socialization was.
Yeah. So if I give like a very political answer, I say, it's 100% and then 75. No, it's like 100%. This is 10%. 10%. Yeah. So effectively, if I take like 1,000, this stage is kind of 100 deals onwards, and then we would invest in 10. Yeah.
One question.
Sure.
What's the timeline for this whole evolution period?
I think I have a slide on this. But typically, high level about 3 months. Yeah. But sometimes, so it happens sometimes that we get a deal here we like so much that we do this within a week. It happens sometimes, but it's rare, but it does happen sometimes. Yeah. Oh yeah, and then the other thing is the reason why this is important is there's not much data about the companies itself. So there's not much revenue, not much metrics. So this is very important for us. To gauge whether the company is investable, yes or no. Go. Hey guys, this is slide number 7. I have 400 more slides, so it's let's see how we go. Cool. Want to talk about the founder's journey. So I just had some. I just looked at some stats, which is interesting to me. Some of them are a bit older, but just kind of to keep you guys motivated. So 90% of companies fail, of new companies. So basically, if you are, I think they mentioned this is beyond seed. So if you raised your seed, you're part of the 10% that doesn't fail. This is interesting. So this is in 2018. So 82% of the businesses that went bust had cash flow issues. We'll talk a bit more about financial forecasting, gross margins, etc. This is 9 times out of 10 a reason for a business to quit, but there's always other reasons for it. So there's underlying drivers why the cash flow is running out. So we'll kind of talk about this as well. So what else is interesting? Yeah, running out of funding is kind of a typical case. But it's very interesting that, again, if you are building a company, it is very rare for companies to survive that sort of initial period. So hence, a few things that we're going to talk about are very, very important. So I call it kind of managing the highs and the lows. And this is like a constant roller coaster ride where, fundraising, everything that you're going through is going to be extremely difficult and painful. But there are ways you kind of are able to manage it. It's funny, actually, I actually made this slide this morning. I had to think a bit longer about if you look at your entire journey as a founder, like where do you go through? So there's always your kind of initial mindset. You're just starting. It's growth. You're thinking about growing the business, growing your team, growing your base, growing your product. So everything is about growth. Then if you get beyond that initial phase, you're going to see that fundraising is going to become more important, and I'll specifically talk about why that is. And then eventually, if all goes well, you want to build like a long-term legacy. You want to do an IPO. You want to become one of the global leaders. So I want to talk about this part first. So bringing the company from idea to reality. And just by show of hands, just so I know, so who are founders in the room? Okay, that's good. So, and then who has raised money as founders?
From personal or from outside?
Doesn't matter, from anyone. Yeah. Okay. 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 So the reason why this is like such an essential point in building a business. So take a step back. So there's something on paper, which is your idea, and you're effectively going to say, from this idea, I'm going to build a company. So every single company on this planet started the same way, kinda, from an idea that has now become reality. What we often forget is we go from this to this. So I've had founders that told me, Mike, I want to exit in 2 years. And then I'm silent, and then I say nothing. And then I ask one question. I said, why? And then it's silent in the room altogether. Because we say we want from this to this, but no one tells me why. Why would you want to go from idea and want to go to an exit? Why is that? What's the motivation there?
Make a lot of money.
Sorry?
Make a lot of money.
Then you can become a banker, right? It's easier.
Banker?
Yeah. I know rich bankers.
I was not.
Yeah, see? Yeah, see? So there are easier ways to becoming rich, right? So why would you want to go from here to here? It's a very important question. Why do you want to go from here to here?
Start a new journey.
You start a new journey. As in a new personal journey?
New project, new startup.
Okay. The word is actually on this slide. Yeah. You're doing this to build a legacy. Like no one, like think of it. You're going to go through all this hardship to make money? No one does that. You're doing this to build a legacy. So if you're building a legacy, that means that all of this has to be part of that journey. So when we speak to founders, and I hope this is helpful for the founders in the room, is when we do our due diligence, we talk about all of these items, every single one of them. So I'll give one example. We had a business in Singapore. The company is called Redmart. So they are an online grocer, and they were the first one. They were the first one in Singapore. They're currently the biggest one in the country. Their entire board, including us, and we were wrong, said, you have to be regional. You have to be in every single country in Asia, and then you build $1 billion business, and that's how you grow. That's how you grow. And this guy kept saying, no guys, I'm building this grocery legacy in Singapore. And yes, he also said, I'm going to make us all rich, but he said, I'm building this grocery legacy in Singapore. And we kept on saying, no, but it has to be about, but you know what he thought, what he had in mind? He was here. He was building a product and a product strategy. So he took groceries apart, brick for brick, and said, I'm going to rebuild grocery from an online standpoint. So how did they start? They started with picking up groceries from existing grocery companies. So you go to like your local grocery store, you do the picking, someone orders online, you do the picking and you deliver it to their home. They eventually went to having the most advanced inventory system in Singapore. And they outpaced all the existing grocery companies that have been there for 15 to 20 years. This founder was obsessed with this. They were eventually acquired by Alibaba. So Lazada, which is a subsidiary, they bought the company. But this founder had two things in mind. He was here when he built the company, and he had this long term in mind. So why was this important? Because he said, I can only become successful if I am obsessed with groceries. And it sounds weird, because no one is obsessed by groceries, but he said, I have to be obsessed to make this effective. So what happens when I interview founders, how obsessed are you about your own product? I do not want to know more about your product than you do. You need to know more. You need to know everything. And you need to prove me wrong when I give you advice. And you say, Mike, this is the wrong advice. Again, we go back to this founder and we told him, you have to be regional. And he said, nope, I'm going to be in Singapore. Their business in Singapore was over $250 million in groceries as a startup in just Singapore. Profitable. So he was obsessed here. The second thing was interesting was on the team. Yeah. He said, I'm going to hire people better than me. What is the biggest founder issue? One of the biggest founder issues.
Hire the team.
Something else.
Fine.
Ego. Who wants to hire someone better than, I mean, I'm going to make myself obsolete? No, of course not. I'm going to hire people that are not that smart, but not as smart as I am. So ego is always an issue. And he always said, no, I'm just going to hire folks better than I am. So he went around, he eventually got the head of logistics for Amazon to work for him. And he wasn't insecure about it. He said, no, we're going to build this company together. He was very aware that this company was going to pivot. And he was open about it. One of the things that I had to learn over time, and it took me a long time, so you guys learn faster, is when there's a company pivot, you speak about it with your investors openly and transparently. It's going to help your business tremendously. Remember what I said, every company pivots, every single one. And it's not a bad thing, it's evolution. So talk about it. So for me, when I speak about socialization, this is part of my due diligence and understanding how obsessed is his founder about this part of the business. He never spoke to me, not ever, not once, about this. I've known this guy, I've known Roger and Vikram for 11 years now. They've exited, they sold the business, but in the 9 years that we invested, they never spoke about this. And they said to me, we'll talk about it when the time is right. And it happened when Alibaba knocked on that door. Okay, so this is clear to you guys, right? Why this is important. Okay. The other thing is around fundraising. So fundraising is not easy. It's doing sales, and a lot of people don't like doing sales, but it's really, you know, it's part of doing business. When you are successful here, this is almost inevitable. If you get this right, this is going to happen. So you know, you maybe want to avoid it, but this is 100% going to happen. So prepare your company for fundraising. We have invested in founders who are heavily introverted, and they found a way to get fundraising done by building a team around them that is amazing at fundraising. So they were prepared for doing roadshows with a team around them that helped them pitch the company. Understanding the difference between strategic and financial investors. It is crucial. Strategic investors have a different mindset to your company. They're less concerned about money. They're actually less concerned about this as well. So if this is your mindset and you have strategic investors on your cap table, you have to align interests and make sure that's going to work out. So know what kind of investors you're going to have on your board. Oh my goodness, investment terms. I have seen everything on the planet in terms of terms. Get these right early on. This is going to hurt your business for a very long time if you don't get it right. So I'll talk about the Redmart company again. When they raised money, they had 80 angel investors on the cap table because there were no VC funds. So they had 80 angel investors on the cap table. Yeah, that's across my face as well. So we looked at it, it was like, this is impossible. He said, yeah, I had to. I said, it's knocking on doors, raising 50K, 100K, 20K. So then he gathered all that money to kind of raise a few million. So we cleaned this up because we said, what is going to happen if you go to like a larger Series B round, no investors are going to take this on, like none. It's too messy. So we cleaned this up. And we also had to renegotiate a lot of the terms. People had different liquidation preference, and it was different discounts on the next round, so it was a bit messy. So we had to clean this up. If you don't know this, get advice. There are smart people also in this room that can help you on this side. So get the right advice on, just be honest about it. Like I don't know how this works. I need someone to help me. Then ask for help. Valuation is not about ego, guys. Valuation is not about ego. If you are valued at a $100 million company or $100 million and you make $10,000 in revenue, that's not a good thing. Valuation is not about ego. Valuation is putting a number on your business based on that you are obsessed by your product and that you have customers that like your business and that they keep coming back and buying more. That's what valuation is about. It's not about ego. And managing your stakeholders. Not every investor is nice. There are very annoying, very not nice, can't say the word, very not nice investors. So make sure that you manage your stakeholders. And that's by doing this. If you're fundraising, prepare. Know what kind of investors you have on your board, understanding your terms, understanding your valuation, and then you can manage your stakeholders. We had a company which went up in valuation twice in 1 year. Initially, we were, of course, happy because it's a markup on our portfolio. But on the other hand, we also realized that, man, there is a bit of a risk here. Because if the market goes down, this could become painful for the company if they go out fundraising again. So sometimes a high number, and you see founders high-five each other, like we are at a very high valuation, could hurt the growth of your business, or it could hurt your next round of fundraising. So make sure it's aligned to your underlying metrics. So when you get all of this right, then you're building a legacy. And then you can actually think about, okay, what does it mean for this business to continue for the next 10 to 15 years? What does it mean to become profitable as a company? Do we want to get acquired because we want to grow bigger, or do we want to acquire other companies, or are we thinking about a listing because we are fundraising? I've had, so within our firm, I specialize on IPOs and listings for our portfolio. So I work a lot with the New York Stock Exchange in New York, and the Hong Kong Exchange as well, and the local exchange in Singapore, the SGX. In my conversations with founders, I oftentimes hear the IPO is sort of the end for us. It's kind of this big moment, and you can ring the bell, and there's photos and newspapers and stuff. It's actually a new beginning, because at the IPO, I'm gone, right? So I can sell my shares, and I'm like, bye, thanks. But the founder still stays. He can go anywhere. So you have to understand that even though it's a very big, significant moment in your business, you're still building your legacy, and you're still kind of building the business. So think about life after IPO, which sometimes, and it's not bad, which sometimes means a change in leadership. It could be that you as a founder, you talked about a journey, you have this itch, I want to build something new. I have more in me. Maybe you hire a CEO and you step down or become a chairman or a president or whatever. So think about, what does leadership mean whilst you're kind of building a legacy? Guys, I can't emphasize how important this is if you are thinking about pitching your company to investors. Specifically this. Specifically this. And so get this right. Get this right. Okay. Any questions here?
Hi, Mike. We've been talking to a couple of VCs, and they always ask, what is your exit strategy? Now, somehow it contradicts with M&A and IPO in terms of exit strategy.
Yeah.
So what could be the next reason as an exit strategy if they don't want to say M&A and IPO?
Yeah, so there's, what I would do is start with asking the question back. And I would ask them, what is your expectation? And then specifically expectation on timeline. So we work with a lot of angel investors that are in our community as a fund. They will do an angel check pre-seed or a seed. And when we invest in A, some of them want out, which is fine. And then we're happy to do secondary and take over their stake. So the first question I would ask is, what is your expectation? Like, are you long-term as an investor or are you more short-term? And then you can talk about strategy for their exit. If they say, hey, we want to wait until IPO, then they need to understand that's going to be another 7-8 years of building the business, which is fine, right? So the easiest way around it is ask the question back to them. Cool.
Mike,
Yeah.
just want to ask a small question. Are we just talking about the product companies, or we are speaking about any company?
Any company,
even service.
Yeah, 100%. Yeah. If you change product for service, I still want you to be obsessed about your service. So 100%, it goes for product and it goes for services as well.
Mm-hmm.
Yeah.
I have a question regarding the investment terms.
Yeah.
What's your recommendation? What's the ideal investment terms that we can negotiate with the VCs and investors?
Yeah. So the one thing, if you're an early stage company, make your life as simple as possible. There is a number of plain vanilla terms just across the board. Like for all of our investments that are seed, like literally every single one of them, it's a safe note. And the reason why, because it's a market standard. Everyone knows what they're getting. Yeah, you have to kind of discuss about the cap and if there's a discount, yes or no. But everything else is plain vanilla. So you make your life as a founder easier, and you make our lives a little bit easier as well. Of course, it gets more dicey at Series A. I think the most important thing for you as a founder is kind of think about liquidation preferences when you're doing an equity round. You want to think about again, everything is in the end then tied to valuations and any preferential rights that you want to give to the investor. The one thing that some investors like it, some don't. There's always a discussion: do you put KPIs in your investment terms? I'm not against it. I think it's, as early stage, it sometimes might be harder because your life is going to change so fast and so often that your KPIs might change, right? So if that is the case, you want to keep them flexible, that you can move them around a little bit. But I would say just don't get stuck on liquidation terms. They can be too high, so keep them simple. And you want to make sure that if you are doing KPIs based on the investment, that you make sure that they're flexible. Okay. How am I for time, by the way? Just checking.
No, it's 10 to 4. So
Oh, okay. Okay.
Just a quick question.
Yeah, sure. Yeah, and then I'll get you. Yeah.
So when you say you put ego aside, right?
Mm-hmm.
Okay, well that's a good thing. But listen, when you move from from seed to Series A, from pre-seed to seed, it's whatsoever, and you are exposed to devaluation instead of valuation, right? For any reason.
Yeah.
You know, they are trying to degrade your prior valuation to a lower one. So what's how this be separated from ego, right? Because every founder is attached to his business.
Yeah, yeah, true. And
so what, like really, I don't know. It's not so really. This is not scientific, not theories, right?
Yeah.
This is really empirical.
Yeah.
Situations.
So there is like no one likes down rounds. Actually, investors don't like down rounds neither. And you're right. It's like if you're building your business and someone says, hey, I want to invest, but at least at half the price or.
They start to negotiate and bargain.
Yeah. So the easiest way around it is, at least the way I look at it, is if you are raising and you're raising at a certain amount, you can think about what is the dilution that you want to take on your business. So if you are comfortable taking 15% dilution in this specific round, and you want to raise 10 million, you kind of know what the price is going to be. So that's the way around it. The other way is if they are asking for a down round, then I always ask, what is your model? So as an investor, they must have a model in mind. So are they doing a VC multiple? Are they doing like some kind of DCF calculation? So you can ask them for their model, so you understand what the number is. Yeah, exactly. Yeah. But I tend, when that happens, so sometimes we have to, on behalf of our companies, we negotiate with other investors. I always tend to talk around dilution and understand the dilution metric that everyone's willing to accept. And that's an easier conversation to have.
Now, can you say a little bit about company pivots and how they manage those in a way that preserves the growth mindset as opposed to sort of diluting energy?
Yeah. Yeah, and this comes down to why are you pivoting? So the initial question I ask is, okay, why is this model not working? Or why are the customers not buying this product or service? So trying to kind of break that down. Then you want to understand if the pivot is close to where the company is currently in terms of product or service, or is it like something entirely different? I think with the latter, and we've had it this number of times in our portfolio, there's a bit of a bigger concern because it becomes a new company. So you really want to sort of understand, like, if this is a new company, what do we do as investors? Do we think that direction makes a lot of sense, or is it something entirely different? Slack is always like the greatest example, right? So it was something entirely different before it actually became Slack, but it still had predominantly the same investors on the cap table, and this was okay. So it's actually funny. So it's because of this, because people believed in the founders. So for me, it's always an open discussion with the investors. If you have investors on board, we've had one company where it was a bit of a tension between us and the rest of the board and the founders, because they wanted something entirely different, which we felt it just didn't make any sense for the company. But yeah, so just having this conversation is the best thing you can do. Cool. Okay, so once you have this, and once you've kind of gone through, this is going to be my journey, and you feel comfortable, then you can actually start thinking about what does my pitch look like. And effectively, what I'm saying is, if we get a company pitch, we always ask very, very similar questions, and these are sort of the highlights for these questions. And in this case, you can it's product or service strategy, could be one or both. We always start here, so we always start with the founding team. So I told you guys earlier, socialization is a very, very big part. So we always have a conversation with the founding team over multiple rounds. So not one conversation, we have multiple conversations over multiple rounds. We then always do like a deeper dive on product or service strategy. So you kind of want to understand, what does your product growth look like? What do you have envisioned? What do you have in mind? Then we have like the overall growth strategy, which is more than just your product. It's your marketing, it's your geographical expansion, it's your team expansion. Like, how do you think about your overall growth strategy as a founder? So competitiveness, like how hungry are you to beat your competitors in this space, and how do you want to go about it? So personally, I spend a lot of time here on operational excellence. So how does your company, or how do you as a founder, how do you stand out? And then we have one person in our team. He's amazing at getting the market sizing right. Internally we spend a lot of time. Typically, when we get a pitch deck, there's addressable market, and then what they're going after as a company. That's oftentimes too easy of an exercise. People tend to say, okay, the market is X big, I want 1%. But then we ask how? Because you're not the only one that's trying to do the same thing, right? So we really want to understand how you're going to get to the market size, what are your underlying metrics for this thinking, and then also, if you come to 1%, then what? What is your strategy then? So that's something we look at. Company DNA, even for very, very young companies, the founders become the companies. So we want to understand what is the DNA of the founders, how do they operate, how do they work. We sometimes, when we look at later stage deals, we kind of look at the path towards profitability, and we spend quite a bit of time on financial forecasting as well. So when we have a pitch, this is kind of the things that we go through, sometimes in more detail, depending on what is available. Cool. Okay, quick want to talk about making a difference, because what you'll notice here is that everything is either linked to the founder or the product and strategy. So when you think about strategy, and this is like nothing new, because this is kind of red ocean, blue ocean, but we always kind of divide companies into these two buckets. It's very simple. Is it an uncontested market, or is it an existing market space? And depending on where you sit in the spectrum, we have a different way of doing due diligence on your company. We have a different way of looking at the competitors. We have a different way of how do you build your product in a market that is uncontested versus a market that is existing, and how you navigate that space. So again, for you as a founder, if you are pitching to an investor, it's just helpful to understand if you are in this space or in this space, because immediately if you're here, my question is, how are you going to beat the competition? When you're in an uncontested market, you oftentimes have indirect competition, and how do you deal with that? So understand for yourself, okay, I'm in one of these buckets, and this addresses how I'm going to pitch my company to investors. And then, by the way, the funny thing here is, like, for here you kind of see where how fast things grow, right? We did our first AI investment in 2015, and up until 2019, no one really discussed the importance of AI for enterprise SaaS companies. So they were effectively in an uncontested market. If you have the conversation now, they're clearly in an existing market space. So even as a company, you're going to move between these two spaces as well. So that's very important to realize.
I think also it's coming under the umbrella of the offensive and defensive innovation management between the companies. Either you will be starting this or you will be following.
Yeah, correct. Exactly. Yeah, that's exactly true. The other thing about your strategy development is looking at how do we develop the markets. So again, if I want to grow and scale my business, am I thinking about selling more to existing customers or selling to new customers? So am I going to grow my customer base, or am I going to deepen my existing customer base? How do I develop new markets if I'm going into a new geography or I'm going in a new customer demographic? Where do I find my sweet spot in developing my product, and how does that exist? And how do you diversify? Like, at some point, if you are in one market with one product, you can imagine that this might become very, very dangerous from a risk perspective, and you want to expand to new markets. So what does that look like in terms of your expansion? There was a question earlier about sort of the fundraising timeline and how we look at it, and I have, I think this is a helpful slide. So when I help quite a bit of our portfolio companies when they get to a later stage, so Series B and plus, then I help them with sort of capital formation and fundraising. So this is typically what we kind of go through in terms of steps. The first question I ask is, why are we fundraising? Are we extending our runway? Are we building a new product? Are we going into a new market? Are we hiring a bigger team? it's helpful to understand because investors are going to ask that question. And then you kind of work with them on what does the pitch deck look like. Like a pitch deck for an angel investor is vastly different than a pitch deck for a private equity firm. So really kind of understanding who is your audience and how do we prepare our pitch deck in the language that they understand. Building a data room, it's always helpful to have one. It doesn't matter how small it is, but if you start early by building a data room that you give your investors access to, it's going to help you down the line because it becomes this automated behavior. And the same as a due diligence questionnaire. So this is kind of all of the preparatory work that you do. Then you kind of go into your sales mode. So you're kind of building up a pipeline, which is always a combination of cold and warm leads. You start with your warm leads because those are low-hanging fruit, people that you know, people in your network, people in your community, and then you can extend your pipeline with cold leads. You know what's funny? No one does this because everyone hates cold leads and reaching out to folks, but it's part of the business. I also do fundraising for our funds. So across all of our venture funds, I support our fundraising efforts. This is part of my day job. Speaking to new investors that I have never met before. So why do people hate this, by the way? Does anyone know?
Because they're afraid of the rejection or something. Yeah.
Everyone hates rejection. It's human behavior. So we try to avoid, the pain. So we go to where it's easy. This is going to change your fundraising strategy indefinitely. Because you're going to open up an entire new category of investors that you haven't even thought of. So your cold lead strategy is very, very important. And then it comes to the execution phase where you're going to actually go on a roadshow, speak to investors, do follow-ups, and try to find, depending on how you invest, try to find the lead investor to get on board. And we talked a little bit about closing. I always talk to my founders about closing because again, it's often underestimated, and this can take months. You can speak about this for months, and you thought you were done, and you're still negotiating on terms and all kinds of different stuff. So, if you have this in mind, and then you can talk with your team about who's going to do what in our fundraising process.
Mike,
yeah.
Regarding sales, in the evaluation for you, the first screening and then before this or socialization. Do you guys go through let's say the sales team, how they do it? Do you discuss with them all of these details? Because as we know, sales is maybe the most important department at any business.
Yeah.
Without sales, there's not any startup will succeed.
Yeah. So it depends on the business. So we've done reference checks for enterprise SaaS companies. So for instance, they have a bunch of business clients. And then we say, hey, can we call 2 of your clients and have a conversation about why they're using your product, why they like your product, when they start working with you, just to get a better understanding. We don't necessarily speak with the sales team itself, but we do kind of course, speak with the founders about the sales process, how they acquire customers, the cost, etc. If the business is slightly bigger, we can talk to the head of sales or sort of the head of account management. Yeah. Cool. I'm just checking. No one is asleep yet. Okay, cool. We're almost there, guys. So if you gotten through all of this, what I've told you, there's just a few things just for you to keep in mind in terms of character traits. And I want to say one thing that's very important before I go into this. For you as a founder, it is extremely important that you believe in your product. So it is fine to be stubborn. It is fine that you believe until end of days in your own product or service. It is fine that you stand for your company and defend your company when you need to. It's important. And some people say, but Mike, I don't want to come off as arrogant, for example. Nothing to do with arrogance. You're building this legacy and no one else is going to do it for you. So you have to stand for your company and for your team. With that being said, it's also important to have a few things. The best founders, I find, that I've worked with over the years are very coachable. And with coachable, I mean that they don't listen to everything I say. Luckily, they don't. But they take in what I say. And they review and they get back to me like, Mike, I thought about it, and I think A and B is good, C, not sure about. So very teachable. They are passionate to no end. They love what they're doing. Although that it's painful, they love what they're doing. It's very, very important. Some people say, like, yeah, you have to make your company, or your passion has to become a company. Not entirely true, I think. But when you picked your product or service, that's your life. That's it. It's very, very important. There's a legendary, so if you go to New York, and if you go to the Waldorf Astoria, there is the founder of the Waldorf Astoria has a plaque. I think it's in the kitchen. I think it's in the kitchen. And it says, do the hard things first. And we all know why. Because we want to do the hard things last. Because we hate the hard things. But it's crucial as a founder, if there's a crisis in your company, you have to act now. You can't wait until tomorrow or next week, you have to act now. So we check on your ability to execute when things get difficult and when things get hard. Close to passion is that you are invested in your business. Again, this is your business, not my business, so you have to be running this and you have to be vested in success of this business over the long term. So experience is very flexible and very broad. With experience, we mean mainly life experience, and are you open to, I say, new experiences as a founder. Although that you're stubborn, you are going to learn, you are going to pivot. So are you kind of open to new life experiences? And are you able to build teams? And there's different ways of building teams, and there's different ways of leading a business. But are you able to build a team around yourself? So are you inspirational as a founder? Are you able to get other people inspired to work harder? So these are the things that sort of in conclusion, when it comes to me speaking to founders, is what I'm looking for more in a personal capacity. I think we're at the top of the hour.
Exactly. And now it's 4:10
And that's,
so
that's the last slide.
excellent.
Thank you, guys.
Thank you.
Well done. I have a question for you.
Yeah.
So I think like most startups start with informals, right? And then from ideation to a first proof of concept. So at which stage of development should founders consider engaging VC?
That's
potential investors?
yeah. So when do you talk to VCs? Like ideally, if it's your very first round, we always like to see some angel investing. So we tend to come after angel investors. So if you do your first angel round or your first pre-seed round, it tends not to be a VC round, just because negotiation takes longer and stuff. So if you have angels on your cap table, it makes it a little bit easier. There are very good pre-seed funds. They tend to be slightly smaller, but they are very good. I think, not sure if I know anyone regionally, but there are, I mean, globally there are some good pre-seed investors as well. But we like to see like some angels on the cap table before we start investing. Yeah. So friends and family, basically.
What about
Yeah.
somebody invested or funded himself from his pocket and took his like startup from the ideation phase to the reality, and
Yeah.
needs now to grow?
Yeah, we see it very often. We see a lot of self-funded companies. It's either their own capital or maybe relatives that help with the initial investment. That's fine. Yeah.
That's your expectations, skin in the game, right?
Yeah, exactly. No, but that's you wouldn't invest if you don't believe in your own company, right?
Yeah.
So that's definitely true. Yeah.
So I think it's a positive.
It's definitely positive. Absolutely. Yeah. Yeah.
Michael, may you tell us a bit about your biggest investment failure?
I've never had any failures. No. Is the camera still on or is it off? Oof. Oh my goodness, yeah, I have one. So we at some point there was a huge trend in the US where all the law firms wanted to digitize their documents, and they basically said what you can do is you go online, I'm looking for a term sheet, and then you have like a bunch of templates and you can download those. So we found the same company in Thailand. We're like, makes a lot of sense, we should invest. But we didn't realize that for most contracts you can use general templates. So it doesn't really matter if I sit in Thailand, in the US, in Europe, you know, if I find a site, it's fine. So this company had no competitive advantage, like whatsoever. So we invested across 2 rounds, and you know, the company kind of died. I think in general the biggest mistake investors make, and we've made those in the past as well, is you tend to spend most of the time on the companies that are underperforming. So what happens is you invested in a company, you like the founding team, you work with them, and they're not doing well. So what you do is help. That's the first thing you do, right? So, and then you help some more, and then you help some more, and even some more. And the company is not doing any better, but now you have invested your time, your capital, resources into this business. You're like, I can't let it fail. So it has to succeed. The best thing you can do, and the most difficult thing you can do then, is walk away. But that was one of the hard lessons we had to learn as investors. Yeah.
Yeah, what we've seen is like 68% of what we invest in just died.
Yeah.
And just 30% of all these, or a bit more than 30%, will just give you the fund that you are investing in.
Yeah.
And 0.4% will give you actually the margin of the VC.
Exactly.
That's what you observe.
Yeah.
And then we came to actually the idea that if you are socializing with the founders, you'll have kind of attachment, you know,
Yeah.
because you like them, you invest in them, and that's a bias.
Yeah,
And
true.
if you would like to build like an asset class, like a VC asset class, then you should not. And at the moment we said will not meet them, the founders at all.
Yeah.
And that's an opinion that we
So,
see that
I guess-
think it has.
Yeah.
And we'll invest money, but with the engagement that actually we have the right to follow up
Yeah.
once we are in there.
Yeah.
Because it's at that moment that you know the real stuff that is fit.
Exactly. I think the one thing you have to prepare for as an investor is you're for at the early stage, you're in this for the long term, and which means that you do get attached to the people, because you know you like most founders that we invested in the past know my kids, right? So they become friends, and you talk about life and stuff. So it then becomes harder to you'd say, well, you know what, no more money for you. So yeah, that is difficult. Yeah.
3 questions, but they kind of overlap. What brought you to Qatar? What's keeping you in Qatar? And what's your impression of the startup ecosystem?
Whoa. Oh goodness. What brought me here? So we have investors in Qatar in our firm. So they politely asked me to come by and say hi to you guys. No, that's a joke. No, we have investors here, and we do some co-investments. I've been coming in and out of Qatar for the past 8-9 months, and I'm keen to learn more, meet more founders, and see what we can do as a firm as well. I think what is interesting for me is like a lot of it I recognize so much from Singapore like 10-11 years ago, and it's because like all of these emerging ecosystems have almost the same trait. And we've seen this happen in Asia. I see it with my friends in LATAM, for some of the funds in Africa as well. Like there's always like this smaller community of sort of high energy founders that want to sort of build some, break stuff, innovate, and that attracts folks like me. Like I wouldn't be here if you guys weren't here. So for me, it's interesting to kind of learn more. Perhaps put some funds to work here and see what we can do to help and support. And I like cycling here, so yeah, that helps as well. Yeah.
Be careful.
Yeah, and be careful. Yeah, exactly. Yeah. Yeah.
General question. During your visit, you said that whatever pitch deck in your mind, 100% you've seen some other pitch deck or something. There was no any idea that was unique. It was your first time you see
see this
One.
one time?
Yeah. Oh, twice. One company in Korea and then one company in Singapore. The one in Singapore was really unique, but there are other companies doing the same. I just hadn't seen them before, so this was the first time for us. They provide quantum level communication between satellite stations and base stations. Like you don't run into a company like this every other day, but they are a top 100 space tech company in the world, so we invested in them out of Singapore. When they pitched us, it's like all PhDs. I had no idea what they were saying. It was very, very complex.
That was my question.
Yeah.
How you react to that? If it's the first time you hear about it or you know?
Like my first response was, if you're that smart, I'm going to invest in you anyway. So they were like really impressive. But then we did a lot of due diligence on the product itself because we wanted to understand, if this would be scalable, yes or no. But yeah, the founders were like from minute one, very, very impressive. So yeah. It happens sometimes that you're so impressed, and luckily that still happens to date. That you're like, man, we should invest. So yeah.
So the past 2 years.
Yeah.
Sorry, someone.
Yeah, no, God, yeah.
No, the past 2 years, like there's appetite for SaaS model,
Yeah.
SaaS subscription.
Mm-hmm.
Startups. Isn't it the case right now? What's happening? Like you came from Singapore, that part of the world.
Yeah.
So what's happening there apart from the SaaS model? What's on the hype?
Yeah, it's a bit of a wave, and the reason why people like B2B SaaS is, I think we've all seen the growth of B2C companies, and we see the positive and the negative. But I think the negative has been high capital burn, fairly high risk on B2C companies, and there is not a lot of sight on profitability. So what happens is, I spend money into a business to consumer company, and this company says, I have to acquire customers, and I have to acquire as many as possible, as fast as possible. So that's going to cost a lot of marketing dollars, and I want to be everywhere. If you're a B2B SaaS company, you kind of work almost customer for customer. Not entirely true, but it's a slower growth. It's a bit more secure. There's clear revenue from B2B SaaS. So investors, and we're just like sheep, right? So we tend to kind of move with trends, and the trend now is finding companies that are profitable sooner, and ideally you then look at B2B companies.
What's the alternative for SaaS right now?
I would say AI. Just put AI on your deck, and then they will invest. No, but like in reality, if you we're laughing, but it's unfortunately true. Like a lot of it is now around AI. I think the difficulty with that now is that a lot of these companies are products and not businesses. For me, there's a big difference between just a product or a feature and an actual business. And I think what I'm now seeing is like a lot of companies are building features, but they're not building an actual company for the longer term. So if you're like now in generative AI, it's going to be hard to differentiate yourself from any other company in that space as well. So.
Can you just repeat the last one?
No, if you're in generative AI, it's going to be very difficult to differentiate yourself as a business model from 1,000 other companies.
Yeah. What about if I use to be a B2B SaaS in addition to investing in my own AI?
No, so I'll give one example where we think it's very useful and we like the business case. So search is a big issue, whether it's consumer search or enterprise search within businesses. I think AI is an amazing feature to add to search, specifically for companies. Like one funny example is if you go to a large business and you ask someone, can you find me the company logo? You get 15 different logos for one company. Because everyone has their own version, their own color. You can actually leverage AI to get you the right one within seconds. So I think there's applications for it, but it's more, you have to kind of think through it first before, but I think there are applications for it, definitely, yeah. Sorry, you had a question, yeah.
Do you invest in Central Asian startups based in Central Asia?
That is a tricky question. I'm going to say maybe soon. I said maybe soon. Yeah, I have to be careful what I'm saying. Light is still on. Yeah, so maybe soon. Yeah.
Why not now?
Yeah. We'll talk after the session. Yeah. Yeah. Cool. Awesome. Hey, thank you guys. If anything, this is my email address. So if you need anything, just reach out. Yeah. Thank you. Appreciate it.